Welcome to the ALX Show, your premier source for DFW real estate data and insights. Let's get to it. Hello, Josh, Patrick. Good to see you again on the ALX Show. Today is a very exciting day in the ALX Show history because we are launching our economics indicator dashboard. It's currently on our website, and there are a ton of metrics and indicators that you guys are looking at and tracking very, very regularly to really give you a data-driven perspective on the DFW real estate market to be better investors, to be better advisors and all of that. And I'm really excited about how this is going to influence your practice over time. But before we get there, we have a big, situation going on in the economics world tomorrow with the Fed reaching a decision or presenting their decision on whether they're going to cut rates. And whether they're going to cut rates by 25 basis points or 50 basis points, we don't know. But tomorrow's going to be a big day. So I'm curious, just to start off, what are you guys thinking, heading into tomorrow, and what's on your mind, and what do you expect, and how would that influence your firm going forward?
First off, yeah, it's just a big sigh of relief. Like, we're finally here. It's been a couple years, really more like 3 years of uncertainty and volatility. And we're not necessarily thinking we're out of that, but we're shifting gears, right? Where it was a rate increase and now we're going to rate cutting. So for us in real estate, anyone out there that's in real estate, anyone that owns real estate, all of a sudden we're starting to get excited thinking that transaction volume may come back. That's the most important thing. Maybe we'll start to get a little breathing room in the credit markets and a little bit more sense of stability as far as where the Fed's going, how kind of the rest of this year is going to play out and into next year. People start to feel a little bit better about that. Anytime you've got people feeling better about, where their loans are going to come in and how that's going to affect values, and all of a sudden people start to be more willing and excited about doing deals. I feel like they can better plan for what's coming. So thankful for that. It's been a long time coming. Where they're going to land, 25 or 50, that's an interesting topic. I think up until what, Patrick, what do you see, Brandon? Up until like 2 weeks ago, everybody thought it was for sure 25, right? And part of that's because they moved 25 points at a time. That's kind of their go-to move. That's what they like to do. So I think everyone just kind of assumed, hey, they're going to kick off the cutting cycle. It's going to be 25. It's also based on some economic data that's come out. Maybe the labor market's softening, but not, still, relatively strong. So maybe there's not good reason to go on what they consider a jumbo hike or jumbo cut, at 50 basis points. But we got some interesting news. Patrick hit on this in the Wall Street Journal. I think, was that this morning earlier this week too? It's kind of been coming out in bits and pieces, but talk about a little bit of that this morning, what we're reading.
Yeah, well, the sentiment has, I guess there's been two schools of thought, and I think there's two schools of thought within the Fed right now too. And that is, do we initiate a cutting cycle at a, typical moderate pace of 25 basis points, signal that like, hey, this is the trajectory we're going on. It's not going to be anything meaningful other than to drive sentiment, like we've all talked about, in the same way that we've got inflation expectations that are so closely monitored. It's almost the same idea for investor expectation. Sentiment wise, it's meaningful 25 or 50 basis points. And the second part of the argument is, hey, you don't want to cut too much up front and maybe panic the market and make investors feel like, hey, maybe there's something bubbling under the surface that we're not aware of, and kind of throw off market expectation or sentiment in that way. Versus the other idea of 50 points of like, hey, we've had rates this high for this long. We're sensing some weakness starting to form in the economy and employment. So might as well kick it off with a strong start, show that we are not going to let the other side of our mandate, the employment part, falter at the expense of, inflation numbers that are already coming down pretty significantly from where we were. So while the market has kind of gone back and forth on whether or not we'll actually do 50, from the really kind of the man who gets the Fed inside information at Wall Street Journal, has been saying all along, like, this is not a done deal for 25. And there is going to be some real debate about 25 or 50. And whether that means they actually will end up doing 50 or not, I'm not sure, but there is going to be some real discussion.
How does it impact us? It depends on what your loans are indexed to. So if you've got bridge debt that you signed up, or you've got any type of floating rate debt that you signed up over the last couple of years, it's probably tied to SOFR, which tracks very closely to the Fed funds rate. So if they drop it 25 points or 50 points, it does impact those loans pretty dramatically. So we've got some deals that are indexed to SOFR. We've got rate caps on those deals, so we're protected. We got some protection in place already. But anything that's tied to a SOFR index is going to come down with that Fed funds rate, which is great. That means less interest on those notes. So yeah, we're cheering for 50. 50 is great. I think if they go 50 early, then that indicates to me that they're planning on cutting deeper, longer. So they're going to bring that they're thinking the neutral rate is actually lower. Somewhere like sub 3 potentially. Where if they cut 25, they want to go gradually. Then that may be an indication that they believe the neutral rate's above 3 or higher, and they're not going to cut as much as maybe what the market expects, or kind of what we want who run businesses, that are so influenced by interest rates.
Not to rabbit trail too far here, but I read a really interesting piece of research come out, I think from Charles Schwab's economic group this past week. It did an analysis of when a Fed initiates a cutting cycle, how much they cut in the first year compared to how the stock market reacts. So the funny irony is we would all like to see a 50 basis point cut selfishly. And as long as it's not at the expense of pure economic growth, that is.
Right.
What they found is that when the Fed cuts, I think their cutoff was 3 or 4 times in the first year. If they cut greater than 4 times, I think it was, in the first year, the stock market, the S&P decline is generally like mid-teens to maybe 20% over that time. But if they cut less, like 4 or less than 4 times, the impact to the S&P was far less damaging. I think it was close to a 10% or so reduction. I don't remember the exact numbers. But the point is, when you get into some real quick velocity of cutting, the impact can be much more substantial in the stock market, which was really interesting to see.
Which makes sense, right? Because now all of a sudden you're fearful. You're thinking, or you're seeing growth decline. So if they're cutting quickly, it's because they're thinking that they need to save the economy. The economy's in real trouble, which means there's going to be less growth, which means those stocks are probably you're going to be impacted. They're not going to grow as otherwise would have in a good economy. So it's all based on, if the Fed's telling it, they're cutting us, they're cutting, whether we can probably see it ourselves, but they're telling us, hey, we're in trouble. We got to fix this, or we've got to come in and prop up growth. So in doing so, you want to go from more risk-based investments to safer investments.
Yeah, because the point is, or I guess the focal point that a lot of people have had over the last few weeks, few months, has been, we don't really know how to read the economy, whether it's up or down. The market's been very mixed in different ways. But like we talked about last time, that employment might be cooling, but manufacturing data might be cooling, and so it's like, what does that mean? How does that impact the economy and things like that? And what exactly are the measurements that the Fed is looking at that is really giving them some hesitation? And so we won't know until tomorrow. But hopefully, in your case, like you're saying, unlocking that credit market, moving some capital through the system would really help. But not too much, which I guess, that's obviously why they get paid a lot of money to do that.
Yeah, you don't really want it to be, because we're heading into a deep recession, right? I mean, if the Fed is seeing something that maybe we don't see, and they're thinking, oh man, we're like really up against it, we see trouble on the horizon, we got to cut quick, and we got to cut by a lot, then that's concerning. That's what Patrick was saying before too, as far as what kind of reaction are we going to see in the stock market if that happens, because everyone's going to be in panic mode. if they didn't telegraph it well enough to say, no, we're just, everything's fine. We just want to get out in front of it. We know that 25 basis points is not going to be that meaningful. It could take 12 to 18 months for that cut to really be felt throughout the economy. So we just want to go ahead and give it a nice, like, healthy start. Well, that's different. If you telegraph that well and you explain it correctly, then maybe people don't panic and it makes sense. But if you come out and everyone's expecting 25 basis points and they cut by 50 and they don't really explain going in as to why they did that, then everyone's going to assume the worst. Like, oh, we're in trouble. We're in trouble. We need to sell off. We need to get safe. And we kind of just need to be prepared for maybe a much slower economy than what we were thinking.
Yep. Yeah. Well, we'll see tomorrow.
Yeah.
And so, yeah, hopefully, so listeners would love your feedback on, how did this prep you for tomorrow's decision, and what do you guys think, later this week as the kind of the fallout ensues. Would love to hear your comments on that. So switching gears a little bit toward the economic indicators that you guys are looking at and have built this big, beautiful dashboard on your website. And I'm so excited for people to jump in and take a look and to ask questions about it, especially on social and all of that. We have a lot of different categories that these metrics will fall into, and I wanted to get your take on what are you guys really paying attention to? What do these numbers tell you just in general about the real estate market? But then what do some of the values tell us about where the market is now, particularly in DFW? So the categories are, and there's probably, I don't know, 40 different metrics maybe. So we have interest rate and a couple of different numbers there. We've got treasury yields, financial markets, where we're looking at how the different indexes are performing right now. We've got macroeconomic data. We've got rent inflation, Texas economy data, and then DFW single family and multifamily data. So walk us through a little bit. What are some of these categories? What do these tell you? And which ones are the ones that you're really keen on making sure you stay on top of, and how that affects what you guys are doing?
I think they're all really important and they all work together. I mean, the way that we built it out is you start big on a macro level, and then you narrow it down to a more micro level, all the way down to like our local market. But the local market activity is largely impacted by the macro credit environment. Like, so what are we going to be able to borrow money at? So we like to look at kind of the broad picture, how that's ultimately affecting the market overall and generally, because that's what's going to determine, what our rates are. And then we like to kind of boil it down and narrow it down to, okay, now what's happening in Texas and what's happening nationally, in some sense, like what's happening globally, right? But then what's happening nationally, then what's happening in Texas, and what's happening here at home in DFW. We also like to look at, other, like the financial markets and other investment opportunities, just to try to see where we stand as far as our investments, what we're offering investors, where do our returns stand? And I mean, they're risk adjusted, but where do they stand relative to what else is out there?
Yeah, I think at the core, this is all like a symphony, and it all works together. All the different instruments playing their part produce one, output of music. And if we were to only just study the, immediate relevant things to what we're investing in, multifamily, supply and demand, rent rates, occupancy, single family, new builds, home sales, inventory. If we just looked at that stuff, it'd be like listening to an oboe the whole time and not getting the full picture of the entire, song. So all of that, like Josh said, is informed by what's happening at the big picture. And so that not only helps us know where we are now, but it helps us formulate an outlook. And that's a hugely important piece too. I mean, 2 years ago, you thought it was, if you were not paying attention, you're only paying attention to the immediate things in your little sphere of investment, and decided like, hey, these metrics are good. It's buy time. Like 2 years later, you're probably looking up like, oh, I don't think that I was considering the whole picture. So
Mm.
we want to make sure that we've got a handle on the entire picture and then understand how they all work and relate together. And that's why you've got things on there like commodity prices. Most people couldn't tell you where, other than like oil and gas, but where the level of any other commodities are. But those are hugely important and tied to um, production, manufacturing, import, exports, the strength of the dollar, inflation. And so we just want to make sure that we're seeing the whole picture when we and analyze where we want to be.
And the national data encompasses obviously the whole nation. So, and every market is unique and different, has different opportunities and faces unique challenges. So, I think we want to see the national picture because that's going to drive national policy. That's going to drive credit policy. But we also want to be really aware of what's happening here at home, what's happening here in Texas, what's going on with jobs, what's going on with corporate relocations here, or people leaving. What's happening with the net population growth? So we want to be aware of the big picture, but then also very much in tune with what's happening here, so we can make the best decisions in real time. I think it's also really important to note that this snapshot, the economic indicators is great. This data is incredibly important, but the snapshot of the data of where it is on a monthly basis is not nearly as important as the trend. Like, where was it and where is it going? And how, looking back historically, what have similar trends told us? Or what's kind of where are the averages? What's kind of the neutral level on some of these things? How do you recognize a spike in one category or another? And what is that telling you? So it's great to, to pull up the dashboard or to go to your own sources and see where things are. But it's only going to be valuable and beneficial if you have an understanding of where things were and what were the circumstances surrounding, or what was going on at that time that maybe drove them to that place, and what's happening now. What can we learn from it? What can we project from it? But that's the most important thing. The numbers are great, but the trends are ultimately, and the trends in context are ultimately what's important when we're looking at this.
I love that. Yeah, so the table is arranged from indicator on the left. It's grouped by category, like I said, but indicator on the left, and then you've got the actual value. You've got the change right in the middle, which is what you're talking about. Is this increasing, decreasing? And then we've got our sources linked, and then we've got the date that this was last updated. So if I'm if I'm tracking with it, we hear on the trend and watching the change of these numbers. So let's say you've got, the prime and SOFR rates are what they are, treasury yields are what they are, and some of that may change tomorrow with the Fed's announcement. But you've got these macro kind of national federal rates on interest rates. And then that, of course, is affected by this macroeconomic data, whether you have your core inflation, whether it's CPI or PCE going up or down. And that affects, the unemployment rate, which we've got marked here. And then you start to see that filter through the Texas economy, like you were saying, like start macro and then filter down. So within the Texas economy, we've got a lot of growth that's happening in Texas generally, but especially in North Texas. We've got a lot of job growth. We've got population growth and all of that. We've got a lower unemployment rate in Texas than we do nationally. And then, of course, all of that affects your single family and multifamily housing, the real estate data around that. And so over the last few years, North Texas has been one of the hottest markets in the country, if not the hottest, especially in the last year or so. So you've got a lot of growth in new, multifamily homes. You got a lot of growth in single family homes. But it seems like just lately, let's say in the last few months, we've had some increases in average days on market, some decreases in average or closed sales and pending sales, things like that. So if I'm understanding right, we've got this huge boom in North Texas, but we're starting to see it cool a little bit. And maybe that is the effect of some higher interest rates, some of those prime, federal rates that have been increasing over the last 2 years. And so despite the the growth in Central Texas, North Texas, we've got still a little bit of cooling that we're seeing now. Is that an accurate picture of how some of these metrics might play together?
It absolutely is. Um, you know, you've got to, like Patrick said, you've got to take it all together. So just like the way you're looking at it, um, see where the rates are and then where the activity is. How are the rates affecting the activity? Just like you're saying. And um, it could work the opposite. Right? You could have really low rates because the economy's in a bad place, but you have low activity because people are unsure about whether or not they're going to keep their jobs. So
Mm,
so there's, and that's why it's so important to look at everything together, and to notice, watch the trends. So when things change, to be able to, nobody can see the future. That's not what this is for, but to make the best decision that you can based on as you see things changing and like different pieces moving, because they all move in concert, and seeing how they're affecting one another and how they've affected one another in the past, to get an idea of what's going to maybe happen, this time around. Every time's a little bit different,
mm,
but that's the best we can do. That's what we got. That's the best we can do. Now, what you said, as far as here at home, I think rates are having a big impact, right, on transaction volume. I think you mentioned single family, the single family market. Now, mortgage rates have moved down significantly. We're down to about
mm,
6% on the 30-year, so it's
mm,
come way in. But I think we're still, even though it's come in, because there's been such a lack of inventory, prices have
mm,
not come in. We're still trying to work on that supply side of the equation. The demand side it has increased because it's more affordable all of a sudden, just from a rate perspective. But that price
mm,
is still up there because the supply side is not where it needs to be. We've now it's changing. We're getting the days on the month supply is moving up, but I think a big reason for that is just people are unsure. Like, right, we got an election
mm,
coming up in 2 months, and then we got these big interest rate decisions. So I think people are just sitting it out, not for the long term, but just here in the short term until we get a little bit better idea of where things are going. And I think just like human nature, once people start to feel more comfortable, you'll start to make decisions. Sentiment drives so much behavior. And so when people start to get a sense like, okay, um, I think I've got a pretty good idea of where rates are going to go. I'm not going to miss the boat, right? I'm not going to miss some drastic drop. Now, the fallacy in that thinking, though, is if there's a drastic drop, it could push prices higher and it could turn it more into a seller's market where now the seller is in more control right now, even when when the rates are a little bit higher. And you might think, well, are as more people list, are prices going to potentially maybe dip a little bit? Is there going to be any type of correction? Well, sometimes what people don't think in thinking that way is that right now, in the first time in a long time, it's more of a buyer's market, meaning
mm,
that you can probably get, I think prices are probably going to stay where they are or go up. So you can probably get a better price today, albeit at a slightly higher rate. And you can also negotiate better terms because inventory is starting to tick back up. Days on market is going back up a little further. So you've got to be able to see like kind of the opportunity within each market which within each cycle or within different sets of circumstances. So and that's important. Why you got to see the whole thing and have both see where we are now and kind of have an idea of where we're going, and make the best decision you can. But we are seeing things soften just a little bit, not in the price. Like the prices are basically where they are, or kind of staying where they are, going up just a tad. But I think in large part because of people just wanting to wait and see how things shake out. I mean, the election's huge, right? The
mm.
elections change a lot of things, so that's a big one. And then having rates up so as high as they went in such a short period of time, it shocked the market. And now everyone's just kind of waiting to see, well, what's the fallout going to be, and what's going to happen this week, and what does that mean for me personally when I'm ready to make a decision to buy or sell.
Awesome. Yeah, I agree. What you're saying makes perfect sense because you can see that in the trend where you have the average sales price is almost at 470,000, and that's up almost 1% year over year. But you've got the sales, closed sales, pending sales down almost 8.5% year over year. So you've got sales are slowing, but that price is still sticking. It's even rising year over year. So yeah, I see what you're saying about the kind of orchestration of all these numbers working together.
What's funny too, we always think about decreasing interest rates is stimulating more demand in single family or multifamily or whatever you're buying or selling, but falling mortgage rates, we always think, oh, that's going to bring, more willing buyers to the market. But I think it has the same effect on the supply side too. And I think that's part of the reason why you see inventory ticking up is everyone who bought, 3, 4, 5 years ago has been kind of trapped, and there's been this pent up supply, so to speak, where if you didn't have to move, you weren't going to. But I think with mortgage rates falling, a point or more in the last couple months, sellers are thinking the same thing as buyers. Like maybe this is a good time to finally go ahead and pull the trigger. So we're seeing the same thing in multifamily right now too. We talked to a debt broker last week who originates permanent financing through Fannie and Freddie. And I asked him what activity's been like over the last month. 10-year treasury's fallen probably 60, 65 basis points in the last 30 days. And he said they've got 22 properties under application, and I think it had almost 50 inquiries to, and now Fannie and Freddie have got a backlog of getting all that approved. And so everyone's ready to move.
Cool. Yeah. I mean, your boy's interest rate is at 3.75. So I don't feel like moving anytime soon. But yeah, a lot of people feel that way,
Well, what would it take, Brandon? That's a good point. So you're at 375 now.
Yeah.
Life circumstances may dictate that you got to move, but
Sure.
if you have the option, what rate would get you to start thinking, okay, yeah, maybe I can let go of this 375?
I would think in the 4s probably is where I would that because then it starts to make where it's not such a jarring financial decision. That's just my take. But we have a lovely home that we just bought 2 years ago, so I have no like real strong interest to move. I would call Josh if I did, but
That's a good carry.
Yeah, that's right. But I saw this stat the other day, and you guys know this. I mean, anybody listening knows this. But I saw this. Somebody was posting about it, I think, on LinkedIn. That was like, if you bought a $700,000 house at 3.5% or 2%, or was it like 2.8% or something like that? Back in 2021, it would be the same exact monthly payment of like a $380,000 house at current interest rates 5.8, 6% or something like that. So it's like I'm literally getting half the house that I would have otherwise, and that's huge. So I don't want to let go of that very easily, but most people feel that way, I'm sure.
Yeah. Yeah. And that's why a lot of people think that even as they start to cut rates, and as we talked about before, the Fed funds rate doesn't directly impact mortgage rates, but it does, it does impact them, just not directly. That it's not going to necessarily just light everything up. Like it's going to take a little time for mortgage rates to get maybe closer to 5%, to the low 5s, to where people really start to think, okay, yeah. And this is for people that either need to move or want to move. There's a lot of people in your situation and they're like, hey, I don't want to move. So then it doesn't necessarily matter.
Yeah. I'm not super inclined, but a lot of people are, like you said, and life circumstances will dictate that you need to anyway, but it gets easier as those rates come down. But to our at the beginning when we were talking about how if the Fed does cut dramatically over the, let's say 4 times, 5 times over the next 6 months or so, or several months, maybe that will make people move a lot faster. I don't know. But then again, maybe it calls to like, how's the economy doing?
Right. And that's
makes it a lot scarier.
Why are they cutting so fast? Are they cutting fast just because they overdid it and it's the only way to preserve a soft landing? And say that in quotes. Not saying it's not possible. It's just going to be really difficult. Are they doing it just to nail the landing, or is there something a little bit more ominous there? And if that's the case, then that's certainly going to hurt activity. Because people aren't going to feel confident in the economy and their job, and making a big move and taking on more of a payment, which is what they're going to be doing, because the rates are probably still going to be higher home values are going to be higher, than where they bought in. So all depends on the why. Why?
Yeah.
What's the why behind the move?
Yeah, and what's the expectation? Yeah, exactly. Okay, so last question is, if there was somebody that is just landing on this this dashboard, there's a lot of numbers. Like I said, there's probably 40 numbers or so. Is there one in particular that draws your eye when you look at, whether it's the macro or the micro DFW side of things? I know you've talked before that the 10-year Treasury note is one of the key numbers that you guys are looking at when you're thinking about either investments or the way things are moving on the real estate side. So would that be the number that that kind of draws your eye, or is there another one that you really look at that has your attention?
It's so circumstantial. It's hard to answer, but
Yeah.
because right now you probably pay a lot of attention to the labor numbers, right? To the labor market, but
Mm-hmm.
only because though that's what the Fed has indicated that's most important to them right now. So we're trying to get in their head. So you're looking at the labor market and trying to guess maybe what they're thinking, what they're going to do.
Yeah.
But then that just shows you how important kind of the baseline interest rates are, because that's really what we're after. What are they going to do with the interest rates? 10 years always important. 10-year is Patrick's, it was a banker initially. So he can tell you, I'll let you speak to him about why the 10-year is so important to the overall economy.
It is just the benchmark for borrowing rates, not just here, but really worldwide. And so anything that's, a longer term fixed interest rate is generally going to be driven by the 10-year Treasury. So it's probably the most important metric on here. And you can make an argument that it's always chicken and egg, but what's driving what? But the 10-year Treasury filters through almost every piece of data on here, either directly or indirectly. And so we know that when yields are moving down, we're going to increase activity like we've been talking about. There's going to be an effect on the stock market. There's going to be an effect on what we can import and export. There's going to be a GDP effect that flows through there. So it really just drives everything that we look at. So
what about jobs and wage growth too? Just considering what impact that has on the GDP with 70%. Is that right? Consumer spending. So track wages. What are wages doing? Because if wages are decreasing, what does that mean for inflation? If inflation starts to come down, what does that mean for the Fed, rate cap? So but local and national wages are incredibly important because of the impact that the consumer has on the overall economy. If the consumer can't afford to spend, the economy is in trouble. It just makes up such a significant part of growth.
Yeah, very true.
Yeah, what's cool is for listeners or folks that will go to this dashboard, like I said, we've got the values and the change in those values. And so, for example, on the 10-year Treasury note, the last updated value is 3.66%, which is down slightly month over month. But we updated those. We'll update these monthly and ongoing in between as new data comes out. But you can always go to the source linked there, unless it's a local bank or a local debt broker or something like that. But we've linked the source wherever we can, whether that's the Wall Street Journal or the BLS or Dallas Fed or something else. So if you want to get updated metrics, as best you can, we've got a whole list here of a bunch of stuff that you can check. And so it's a really, really helpful resource. And so this is, you can find it at alxrealestate.com/economic indicators with a hyphen in between economic and indicators.
And we love it too, right? I mean, all three, we love it if people reach out to us and asked us, what does this stuff mean to you? Or what are your takeaways here? And there might be things on here that they're suggestions. Hey, have you thought about, tracking this or that? But we just want to have those conversations. We want this to be a resource for people because we want to build relationships. Like we talked about before, we're all about building relationships. We think great relationships lead to great results. So we want this to be a resource for people to reach out and just get to know us. This is something that affects us all. We can we can all talk about it. It's relevant to everyone here. So please, like we'd love to start the conversation. Tell us what we're missing. I mean, we want to get better too. Tell us what's not on here that should be, and just let us know what maybe what you want to see. Hey, I like following this. You guys do this that way. I don't have to. But what do you think about adding this? I'd like to see this on there as well. I mean, we'd love to hear that stuff.
Yep, 100%. Yes, this is a free resource. So everybody in the investment community or real estate community, especially in DFW, this is yours. Like let's talk on and make this something that's useful for everybody in the community. We want to be a resource to help you guys and have those kind of conversations. So yeah, please reach out. We'd love to keep this live and kind of a living document to track what's happening in the world. Awesome. Well, gentlemen, thank you so much. I'm excited to release this into the world, and I'm also excited for the Fed's decision tomorrow and how that impacts ALX and DFW real estate. So we will talk next time about maybe the fallout from that.
Sounds good. Thanks, Brandon.
Thanks, Brandon.
All right. See y'all.